Huge news from Jerome Powell this week saying that we can expect some rate decreases coming very soon. This sent shockwaves through the stock market, and in the past couple days, the S&P 500 gained like crazy. Right about here on Wednesday was when the announcement happened. And boom, it shot up like mad. And as soon as Powell explained that not only were they anticipating to cut rates in 2024, but also that they're keeping the rates the same for now and most likely never going to increase them. The Dow continued to rally days after the announcement and as more and more information has surfaced. This whole announcement has huge implications for the stock market, our savings accounts, and definitely the housing market. There's also some hidden messages in this announcement that are not gaining much media attention, so I wanted to fill you in on this quick video today. Now, being a university professor and academic, it's my daily job to research and thoroughly dissect through data and through quotes to find out the actual information. Media is great at scaring us or hyping us into thinking some type of information, and this time they did it again. CNN Business states, Dow surges to new record as Fed signals 3 rate cuts in 2024. The Financial Times said, Federal Reserve triggers market rally as it signals interest rate cuts in 2024. And the Wall Street Journal proclaimed, Fed begins pivot toward lowering rates as inflation declines. Now, none of this is untrue, but it's not telling the whole story of what was actually said. So first, let's discuss where we are and why that's so important to understand right now, because this is why the stock market could really shoot up in 2024 and 2025. So obviously, we all know and have felt that inflation has increased crazy and that our buying power has substantially decreased. Things at the grocery store, gas pump, and restaurants have gotten insane. But with that came some good things. Certain treasury or bond yields started getting very favorable, and even high yield savings accounts and money market accounts started getting very, very nice. Think about it. In the stock market, somebody puts their money into it thinking that or hoping that that thing's going to go up, but they also understand or should understand that they are risking something. There is a chance that their money could go down or they could lose money. So there's risk involved. If something is totally guaranteed, like a savings account or money market account or even a bond, and there's no way you're going to lose money, you just may not gain as much money as putting it into a stock or something, but at the end of the day, you won't lose any money. That's just a safe place for you to put your money. And then on top of that, when they're starting to give you something like 4 to 6% in this totally guaranteed type account, a lot of investors started saying, that sounds like a great idea. I'm going to throw my money here while we wait out this volatile market. So this was just the safe and smart option over the last year or so. And many people were not only putting new money into that, but they were also taking money out of their investments, out of the stock market, and parking that over in these high yield savings accounts or money markets to hold off for a little bit. This just means that there's a lot of money just chilling out on the sidelines. For context, there's currently almost $6 trillion just sitting in money market fund assets waiting to be deployed at the right time. So when the Fed decides to start actually cutting those rates and the rates start coming down, that means that high yield savings accounts and money market accounts and bonds, those rates are going to drop as well. And so then those people that have a bunch of money there are going to start saying, now it's not so favorable for me to have my money in those type of accounts when now they're only getting like 3% or 2%. That's barely even keeping up with supposed inflation. So at that point, they're going to pull their money out of that and start throwing it back into the stock market. And all those people and institutions making that switch means more money funneling into the market, which means asset prices rising like crazy. So understanding this for us today is incredibly important because you don't get rich investing in the stock market at the same time as everybody else. You get rich if you're in before everyone else. So when will that stock market start to increase? Well, that is part of the most important piece of what was actually communicated in that meeting. Committee members penciled in at least 3 rate cuts in 2024. The committee's dot plot of individual members' expectations indicates another 4 cuts in 2025, or a full percentage point. 3 more reductions in 2026 would take the Fed funds rate down to between 2% to 2.25%. This is very important not just for stock investing, but also for housing. The media has been quick to exclaim that rates are dropping soon and that everything's going to go back to normal very, very quickly. But what was actually said there is very important. They said specifically that they plan to slash rates 3 times in 2024, but each time will only be 0.25%, if any. That's less than what the market has been pricing, but more aggressive than what officials had previously indicated. You see, the market prices in this information. The stock market isn't purely reactive. Most times it's forecasting, and people are investing with the idea that if this happens, then this should go up. So people and institutions have been making bets that the rates will drop, and because of that, this is what's going to happen. So all in all, things were already priced into the market, and so with this new information, that kind of changes some things. If the stock market has been betting or pricing in that we were gonna see bigger cuts than what they just announced, then that means that the stock market is overpriced, at least for today. Moving on though, the schedule to get us back to normal takes us all the way through 2026 and into 2027, very, very slowly. Specifically for those who have believed the hype that house mortgage rates are going to drop quickly in the next 6 months or something, and so you're going to buy this house, not care about the rate, and maybe it's too expensive, but you'll just refinance in 2 or 3 months when it comes down. Those are the people that are going to get hit hard because it's looking like those rates are going to stay pretty stagnant for a while. They're barely going to drop over time, and so the price that you have now and the rates that you have now are going to be very, very similar for quite some time. This is important for people buying a house, people who have just bought a house, and then also for people that are investing in real estate. The other big thing that was somewhat communicated, but very politically, was this idea of the actual timing and the actual plan. Nothing is definite. Nothing is being said like, at this time on February 10th, we are going to decrease the rate by 1%. This whole thing is a wait and see situation, and this announcement is their best guess at a forecast. If things continue as they have been and inflation continues to lessen and have a good trajectory, then it shows that things are working, and so they'll keep it the same. If though, for some reason, inflation decides to start rising super hard, they're gonna need to increase rates again because they need to pull down that inflation. But as they said a couple times, they don't think that that's gonna happen, which is a good sign for sure. What they absolutely will not do is cut rates too quickly or too much, especially at first. Because if they did that, if they were to cut rates too fast, and then inflation rises or something unfavorable happens, then they're gonna have to go back and raise twice as fast, which is gonna do more harm than good overall. So they're gonna definitely take this slow and steady, especially if what they're doing now is already working. Most believe the first rate cuts will happen between April and June of 2024, and again, it's not going to be anything substantial. What I do believe is going to happen though, is that when they make that first rate cut, no matter how much it is, even if it is as small as 0.25%, the stock market and the market in general is going to go crazy. And those who have been invested and investing diligently up until that point will definitely see the biggest profit, because they will have got in at the bottom before the market spiked. As the Fed starts to really drop down those rates, like I explained from before, and the high yield savings accounts and the money markets go down from 5% down to 2%, people will definitely be transferring their money out of that and into the S&P 500 or good index funds and ETFs, because that's going to be the better place for their money and for them to make some nice profit. This type of influx is going to make the market surge, and it's going to make us who have been investing very happy. Here's what I'm going to do. Pad the high yield savings account, cut down on unnecessary spending, and definitely pay off any credit cards. I'm going to continue to dollar cost average into the S&P 500, SCHD, and my growth ETFs. Specifically, SCHD is going to be the one that grows the most once those rates do get pulled down, so that one I'm definitely dumping a lot more money into. I'm also investing a small portion of my portfolio in Bitcoin and definitely keeping my eyes out for new business investment opportunities. Watch this video now to continue your investing and keep you going on that road to financial freedom.